Welcome back to another episode on the Gold Room podcast. Today, lucky enough to have Alex from Barton Gold.
Yeah, no, I'm from South Canada. No, I grew up in the US. I was born in Georgia, and so I studied finance, economics, and accounting just for fun.
What's the best advice that you've ever received?
There's knowledge and there's wisdom, and wisdom is the product of knowledge times pain, right? The Australian dollar gold price will get to $10,000. I'm not sure when. And a lot of people have made the comment that, we're no longer playing mining, we're playing geopolitics. Like, geopolitics are diving right down into these assets. And now we've come back to this mill and we're working on this again. And the idea was, like to describe it as sort of doing second things first. So we've got this sort of reputation for being very scrappy and making these assets pay for themselves, which I love because I come from a sort of distressed credit background, and I walk out to what looks like a junkyard, and I just see piles of money everywhere, and I'm trying to figure out how much does it cost me to lift up that money and extract it. You learn all these things when you do your education, and all these acronyms and ROTI coefficient, return on time invested.
Welcome back to another episode on the Gold Room podcast. Today, lucky enough to have Alex from Barton Gold. Mate, thank you very much for joining me, taking the time, just after the RIU conference.
Yeah. Well, thank you for having me in.
Beautiful. Mate, we always start with the life and the times. So take us back to the early years. Obviously, the accent, you're not from locally around here, are you?
Yeah, no, I'm from South Canada. No, I grew up in the US. I was born in Georgia, actually, as a child in Atlanta. And at a pretty young age, moved to Seattle, Washington. So my parents, an age-old American tradition of divorce, opposite corners of the ring, ended up growing up outside of Seattle, Washington. And so went through kind of my formative years there, which was great because that's a beautiful part of the country. Spent a lot of time outdoors, hunting, fishing, backpacking, biking, everything. And went to California for a few years to go to school, as you do, for undergraduate. And I studied, I went the sort of finance economics route. So I studied finance, economics, and accounting just for fun, in theory.
You enjoyed it?
Well, look, I don't think anyone enjoys accounting, but it's a very useful backbone. But the finance and the economics component I really liked, and probably mostly the economics side of things, because I think the more you do it, the more you realize it's all just social psychology and how are people thinking?
Needs versus wants.
Needs versus wants, fears versus greed. Short-term panic versus long-term euphoria. It's really interesting. We see this every day in the markets that we all participate in as junior companies, big companies. But so I really kind of fell in love with that discipline. I loved kind of game theory. What will people do in these situations? I had the opportunity to study abroad when I was an undergraduate student. So it's a fairly common thing in the U.S. to do kind of a study abroad exchange program. And I was fortunate enough to get into a program in Spain, where I studied at a combination of UBC, University of Barcelona, but also the Pompeu Fabra, which is a pretty well-known economics faculty in Spain, and then kind of fell in love with the idea of being in Europe. So I went from undergraduate in the U.S. to graduate school in Europe, and I was frankly quite fortunate because I was I was a smart guy. I was an honor student, but I was very much a student athlete and didn't necessarily fit the visible mold of like an academically successful student. So I think people were very uncertain how to measure me at the time. I was much bigger, big thick neck and all that kind of stuff. But I had a great mentor when I was in my undergraduate business school, who exposed me to some really interesting opportunities when I was there, including literally structuring a kind of a hedge fund trading model for real estate investment trust for this real estate developer, and that then led into conversations with an admissions counselor, one of the faculty for Oxford University, and so I got invited to come join a mathematical economics course at Oxford University. The Said Business School. And so I went and did that. And then I got invited to go to Cambridge the year after that. So I went and did that. And
Wow.
it was one of these very fortuitous things where I was truly the wild card in my class in Oxford. And we had just, we had an amazing group of people, but like really, really razor sharp people. And I was like the maverick, sort of like maybe didn't quite fit in, but it was, or you might not have expected to see like me going to Oxford maybe, but it was just an amazing year, absolutely amazing year. And just such an immersion in just deep history. The college that I was in was, 4 times older than my country. Right. And then I worked, Cambridge, and then ended up working in London for a structured finance team inside of the Barclays Capital umbrella. And then...
How old were you then?
I was 24 or 5, I think. Yeah, 24 maybe, when I was working for Barclays, and 24, 25, 26. I was there for 2.5 years or so. And then we all remember that the global financial crisis, right? So the team
So you were there for 2008?
I was, yeah.
Wow.
And the team that it was an interesting experience, because I think we in that team all felt like we kind of saw this train wreck coming from a long way away.
The Michael Burry.
Well, it was very different. And I had actually had a background in real estate. Securities investment, and had spent a lot of time looking at that, and again building a kind of a long strategy and leverage real estate investment in the early 2000s, when I believed it was really, really undervalued. There were real estate investment trusts that people had forgotten about them in the 70s and 80s after the first sort of inflation and interest rate crises, and Paul Volcker jacking rates to the roof and crushing all these companies, and real estate investment trusts fell out of favor. But I realized they were really, really undervalued in the early 2000s while credit was, going up, and they had been valued 4 years ago, and now they're trading at a 60% discount to net asset value. I subsequently turned around and formed the view that we should go short real estate markets. And I did actually build a short portfolio around home builders. And the thesis was sort of similar in that respect, that, clearly credit was out of control. I remember I wrote a very short paper about, what is this, what are these subprime loans that are popping up? Like, this is clearly a dangerous thing. If a dead person can get a mortgage, it's not a good idea. But the big thing on the real estate side for me was looking at these home builders, right? So I had 2 friends, really smart guys, who went to Southern Methodist University in Texas. So this is a really, really good undergraduate business school. And these guys could have gone into, consulting, investment banking, and they actually went and started working for a mortgage broker. And I asked them, like, what are you doing? Why are you doing this? And they said, you would not believe how much money we are making issuing subprime mortgages. And
Those two blokes helped ruin the American economy.
Yeah, basically, right. And they did all right. But I remember it was sort of like the movie, and I went to visit them, and I was sort of saying, like, explain this to me, like, how does this work? And they said,
this sounds like The Big Short.
And they've made the story very glamorous in that movie, but if you think about the core of that story, it wraps around some very basic observations. And they said to me, look, it is unbelievable. Somebody who has been bankrupt twice can walk into our office on Friday afternoon at 2 p.m. and at 4:45, before we've closed the doors, they're walking out with a mortgage for 120% of the value of a home, so that they can, fill the garage with toys. And on Monday, we don't even own that mortgage. We've taken 3% off of it and sold it onto a bank. And I just thought, like, this is unbelievable. So what I was focused on is okay, if that's possible, then any home in the U.S. should be saleable, because somebody can borrow more than 100% of the value with no proof of income. I started watching the home builders, and these home builders were borrowing billions of dollars of short-term capital to build all these huge tract homes. And the thing that signaled trouble for me was these home builders started to have increasing levels of unsold stock at, like, homes, right? And I'm thinking, right, if a dead person can get a mortgage and they can't sell the homes, and these guys are financing billions of dollars development on 1 and 2 and 3 year paper, eventually the payment's going to come due for the builder. and they're going to collapse. So I built a short portfolio just using put options, like way less sophisticated than all the stuff in the movies. And that did really, really well. In the meantime, I was working for the structuring team, and we were doing like cross-border tax structured principal investments. So really mathematical, tax law driven structures with billions of dollars and all these things. And it was a very profitable business. But the really informative thing for us during that time was everything that we did was essentially built using rates. So whether it was interest rates, foreign exchange rates, swaps across various different rates, commodities prices, futures, all these things, we started to see really unusual kind of movement in rates, and we started to have more and more conversations with our treasury group about what exposure we could take and how much they needed us to sort of like rent the bank's money to do these things. And this is all very typical stuff inside of a bank and investment banking team. It's who's using what money and who gets what credit, and how does the profit get split up. But we got the sense, I think pretty early on, that something was wrong. And was
there any whistleblowers? Was there anyone out there vocalizing, "Hey, listen, this isn't right"?
Look, I mean, I think there were a lot of people flagging that there was a lot of very unhealthy conduct going on in these big subprime lenders. But the whole thing was set up to basically pump out these mortgages, package them up into securities, and then move those securities off your book. So even the people who were maybe most exposed to that side of what was going on, the stuff that was really going wrong, it was almost like probably a fleeting thought for them, because in their mind, they're like, I'm not really taking that much risk. We're not exposed to trouble. It's all these people who are buying all this stuff, and it just runs off into the ownership of this, faceless pool of investors. We weren't working in those products, but we could see some very unusual things happening in the rates markets. And then if you remember when, Bear Stearns had to be saved by being purchased for a fraction of their value, they were a major trading partner of ours. And that was a really big warning sign. And then as things moved along, by the time Lehman's came around, we were very, very sure that things were going to go very, very wrong in rates markets. And I remember standing there on Monday morning after working all weekend in a sort of a panic session to try to unwind a bunch of trades that were exposed to them. Because, on Friday, everybody thinks, they're going down on Monday unless there's a miraculous refinancing. I remember
government bailouts,
and it was obviously a big deal, because if Lehman's went down proper, it was going to be the first big bank that actually failed. It's one of the oldest financial institutions. It was deeply rooted in the UK and the US and had all these global operations. I mean, nobody really understood how big the ramifications could be. And I remember, much like these movies, it's sort of deeply ingrained in my memory, having that sort of shock memory of we've all been awake for like 60 hours trying to figure out what the exposure to Lehman's is, and we're standing there on the top floor of our building with coffee, just out of our minds on caffeine, and looking down literally across the water in Canary Wharf in London. We had a view of the front door of Lehman's building and just people going in and streaming out with boxes. And it was just as profound as the movies did a good job of capturing the energy of that moment. But it was, we were all standing there. It was real shock, like true shock, because I think everybody thought it can't happen. It will work itself out. And then it didn't. Right. And that's quite a moment for everybody. And it's, I think, probably a really good learning point for everybody is unfailable things do fail. Yeah. Right?
Mate, before we get into, and this, I don't have this as a question, but I think it's very important we go over the Australian housing market. Now, before we get into Barton Gold, just with this, with your experience, what do you see with the current housing market? You're talking about builders collapsing. Every time I open up, it's the Daily Mail. It's probably not the most reputable news source out there, not like the Gold Room podcast.
Of course.
But I see these construction companies collapsing. I see these building companies collapsing.
Yeah.
We have a crazy housing shortage. Mortgages they're probably not handing them out like they used to, obviously, but to buy a house in this market, like, it makes me scared for my 2 young kids. I think to myself, unless they do something amazing like become a mining engineer, they're probably not going to own a house.
Yeah, well, actually, you touched upon something really interesting right at the end there that really does make me a fan of Australia and the mining industry generally. And, it probably, well, it should go without saying, but I'll say it anyway. I count myself extremely fortunate to have found myself in Australia. And I literally came from the UK when we knew this was all coming off the rails. I had a Spanish-Australian girlfriend who had grown up in Sydney, was tired of, the rain in London. And we said, look, things are going to get really crazy here. We will go somewhere nicer for a couple of years and see how things go. And ironically,
is this girlfriend now your wife?
No.
Okay.
Ironically, yeah. So the joke is, sort of, I came here for her, she left me, and I never left, right? And that, and that's literally what happened. I actually, literally came home and her stuff was gone, and I was like, oh wow, okay. But
at least you're here.
Exactly.
That's the bright side.
But so when I came to Australia, entering this new market, I was like, right, there's sort of in my mind, 3 main things that I can get involved in, that I can bring my skills, in sort of finance and structuring and these types of things. And it's basically mining, agriculture, and the infrastructure that connects all of them. And so, I've been here since 2009. I'm a citizen. My wife, who's Peruvian, is also a citizen, and we both know that we are incredibly fortunate to be Australian citizens and to now call Australia home. And one of the reasons for that, if you think about how well Australia has done recently compared to the rest of the world, and even what you're now seeing elsewhere in the rest of the world, is that broadly speaking, across the Australian economy, there is much broader participation in the wealth that is being generated, right? And what I mean by that is, there are some extremely wealthy people here, right? We see, the Andrew Forrests and the Gina Reinhardts, and people are aware of these stories. But it would be fair to say they're not the only story of wealth, right? Australians generally have a lot of opportunities to participate in what is driving the wealth of these individuals. And the gap between the hyper wealthy and everyone else is not so big. And the distribution of wealth is much broader. And the mining industry is really, really responsible for a good part of that. And that's kind of the irony is right now, children don't grow up thinking, I want to go into the earth sciences, I want to be a mining engineer. I think if people understood at a younger age what a high quality of life is available to them working in this profession, right, which is one of the most advanced in the world in terms of the mining industry, definitely the safest, right? And the broadest based opportunity right now, and I sort of look at Australia as 1970s USA in a manner of speaking, right? You've got this enormous country with basically an autarkic structure in terms of being able to completely be self-sufficient. If we decided to build domestic, petroleum refineries and gas, refineries, you could literally close the borders and just survive and let everybody else do whatever they're doing. Australia has so much ahead of it. And again, I feel incredibly lucky to have come here now. And in a manner of speaking, looking at the inverse, what we see going on in the rest of the world is driven by an accelerating gap between the very, very, very wealthy and those who are not participating in that. And that's what's driven that so-called sort of K-shaped economy in the United States, where for labor participation in profits and earnings started declining in real terms in the 1990s. And that has opened this gap and led to all this social conflict. So back to the housing question, right? The thing that troubles me about the housing market is that prices are going up very quickly, right? and this all really ties back to the same problem we saw in the 2000s and the late 2010s. The amount of debt that is getting printed, the amount of money that's in circulation, every time there is now a problem in the Western economy, the response is print money. When we were kids, we were all taught the lesson of Zimbabwe as a disaster for monetary policy. Like, you don't just print money as a
Robert
solution.
Mugabe. And
Right.
then they were using some of the notes as toilet paper. That's how worthless it was.
Yeah, and that's the instinct to just like pull the printing press lever is how hyperinflation gets going, because it's actually the market's belief that you're just going to pull the lever again leads to deterioration of faith in the decision making of your central bank, and then nobody wants to own that paper. So you can't sell your credit to anybody. You can't borrow from anybody. So you just start printing more and more money, and you end up piling a lot of money in a small place, or you become restricted to your own market, and you blow up your currency. And that's the story of Zimbabwe. It's a story of Weimar Republic, Germany, and it is increasingly looking like it could be the story of the United States right now. I mean, they're going through a massive monetary dislocation as people move away from dollars. But back to real estate. Young people today face a really big challenge, and this is driving a lot of political upheaval. All of this money printing has driven massive inflation.
It's crazy.
In properties, right?
No, inflation, not just in properties.
Inflation,
absolutely everything.
Inflation in everything, right? And I think the real disservice is that because governments want to kind of lessen the blow, they kind of keep changing how they measure this inflation, and it artificially reduces the actual calculation. If you were measuring inflation today the way it was measured in the 1980s, inflation would show up as 10 to 12% per annum, not 2 to 3% per annum. So they keep kind of, if you can't change the result, change how you measure the result, and it's optics.
Spoken like a metallurgist, mate.
Yeah, I mean, and the metallurgists they're always told to back solve and make it balance, right? But the problem though is that earnings don't rise as fast as asset prices, and I think a lot of maybe like hyper capitalist traditional viewpoint, at least in the last 50 years, and certainly I grew up with this message, was like the idea that if you raising salaries too quickly, that's what drives asset prices. And I think in the real world, once you've kind of seen how this works and you realize that it's actually a social response to increasing desperation around the fact that asset prices are going up, then people get very agitated, and then their wages get raised to kind of calm them down a little bit. But they never rise as quickly as asset prices when money is getting pumped into the economy, because that money is getting pumped into banks, who are then lending it to companies who are consuming things and driving up consumables faster than the average person is increasing their earnings. The troubling thing in Australia for me is the kind of ratio between house prices and income that you see. And there's a great guy, I can't remember his last name, but it's a guy named Gary, and he has this channel called Gary's Economics on YouTube. And he's a British guy, and he was a trader for banks, now trades privately, and he talks about social inequality. And the ratio between house prices and income here, it's just been going up and up and up, 6 times, 8 times, 10 times, 12 times your income. And, it can't be the case that making mortgages more freely available is a good idea to solve for the fact that your child is going to have a $4 million mortgage leaving university if they want to buy an apartment in 15 years' time, right? So
do you think that stops? That would be something that, as a young kid, do you go and drive a truck in the mines, or do you go to university and for 4 years and put yourself even further back?
Well, look, I think there's two sides to that, right? One, obviously, getting a university education can be an excellent thing, right? But it's also not actually perhaps a necessary thing if you have an economy structured like Australia's, where you can have very broad-based participation in the biggest source of wealth creation in the country, which is the primary industry. And I live in South Australia, and we have a government there that is actually really Peter Malinauskas is sort of pretty well known as among the premiers for the states, has really been kind of making a point of this recently. And there's an election coming up, so they're getting their big messages out. But the point they're making is, in Australia, you do not need to go to university to have a good job and a good life and to, give your family, the opportunities that they then want to pursue. And this takes me back to the fact that, the Australian opportunity set here is so great, and the stability that we enjoy and the safety that we generally enjoy derives from what I think is a much healthier structure of this industry and economy with broad-based labor participation and earnings. Everybody wants to make a profit, but we are also very focused on making sure that our team and the people that work with us participate in the value that's being generated because they are aligned, they are motivated, and one of the things that makes me the happiest, if we're successful, is knowing that all of our team have been really, really successful and it's life-changing for them.
Yeah. Look, I going back to if our kids are paying $4 million for how many families, the houses getting bigger so they can have more people in them. The houses are huge.
Well, they're getting smaller, right?
Well, they are.
So the price is going up and it's getting smaller, yeah.
But what I'm saying is if you've got a 5-bedroom home and you're having to put your entire family, every possible income earner to be able to pay a mortgage back. And is it going to get to a point where our grandchildren are going to be taking over the mortgage of our children's houses?
Well, you've heard ideas floated about things like 50-year mortgages, and
that's insane.
You don't need to be very good at math to know that you will actually, if it's a 50-year mortgage, you're never earning the equity in the house. You're just paying interest forever. And attaching to the point that you made, right? If you say, well, if everyone's income has got to come to support the child's mortgage, and one of the things that we see, which I find very troubling, and to me was like, subprime mortgages in 2006, I was sort of like, this is a very bad idea, is that one of the policies or sort of the things the banks are doing or the government's doing is they're saying, okay, well, student can buy house with 5% down. So, okay, great. Now you're hyper levered, right? You're basically, if that 5% is what you're actually able to afford today, then you're basically buying that house levered 20-1, right? Whether it's savings or income. But one of the policies that I saw getting pushed was, well, you can get a mortgage for 5% down as long as your parents co-sign. And to me, when I see that, I'm saying, okay, so you're creating a really dangerous credit situation for this person who is not experienced enough to realize that it's not just a 20-year or a 30-year mortgage they got to worry about. It's the ups and downs of life as you go through those 20 to 30 years, right? Everybody assumes signing a mortgage that essentially everything is perfectly stable for the rest of life. They're not going to lose their job, their child. They're not going to have a child. If you're 22 buying a mortgage and you think, oh, my income covers that, and my income grows at 5% per annum, and the mortgage is blah blah blah, and it all works. Well, you forgot that you're statistically going to have children. You're going to have health issues. Your spouse, your partner, may be out of work for a reason. You may have a relative who needs help. And so all of that is really scary. So you're creating this sort of like very dangerous mortgage, and then you're like attaching it to their parents' wrist as well. And the real danger there is not only that the child learns a very hard lesson, but they could bankrupt their parents when their parents are 80 years old. And now you've got a really serious social problem, right? Now you have aged people of aged care age whose own nest egg has been blown up, attached to a bad loan that should never have been offered to their child. If the banks were actually holding that risk, they probably wouldn't, issue that mortgage themselves anyway. They're relying on government subsidy or being able to sell the mortgage. So it's all, these things are troubling. You see them.
Did they just repackage those subprime mortgages and call them something else?
Well, they're probably not as subprime as the really subprime stuff that was going in the US in 2006, because that was really just designed and just about pumping up the market. And again, it was almost like a dead person could get a mortgage, right? And I don't.
They make a joke about it in that The Big Short. I think there was a strippers that had a dog, and the dog's name was in the
mortgage.
On the mortgage, something. It was something like that.
And those things really did happen. Those sort of ninja loans, the no income, no job, no verification. So there was just crazy things being done because, again, the incentive is for the mortgage broker is going to give a $2 million mortgage, and they're going to get a $50,000 bonus, and it's going to take 3 hours, and they're not going to have any risk on Monday, right?
Wow.
So, yeah, I mean, you've got to be, I think, sort of circumspect about these things. Like the potential for these things to build up and up. They seem like it's a good idea, and you're opening the door to home ownership. What you really need to do is figure out how you're going to increase incomes to reflect the rising value of these properties, because we are in a world now where all Western governments are sort of trapped under debt loads that derived of kind of an assumption of dominance and an assumption of centrality. And we could spend days talking about, the situation the US is in right now. But everybody is now printing money. Everybody is debasing their currency. When the market sees the slightest amount of stress, the central bank provides liquidity. And that liquidity, where does it go? It goes to banks. And where do they put that money? They put it into property. Because if it's property, they get $1 from the government, and they can lever it 8-to-1 and lend out $8.
Yep.
So it all goes into property. And if the government is going to be engaging in a massively inflationary monetary approach to managing liquidity in the market, they need to be thinking really hard about how they're going to make sure that that flows through to actual incomes for people on the ground, or you're going to end up with exactly the same situation that the US is going through, where people's real incomes are going backwards because costs are going up. Their income is going up way slower, and then they can't afford to, buy a home. And the Australian dream is no longer visible on the horizon. And when you take away hope from people, when you present them with, I have worked so hard and I am never going to get there, that moment of realization is very dangerous. And it's very bad for, the health of society. And it's also very bad for the mental health of individuals in society.
I was just going to say
and things break down, you want to see when things go really bad when people get desperate, right? Crime is often a byproduct of just desperation. If you have broad-based social desperation, you're going to have broad-based social problems. And I think that's, I do salute, I would not want to be a politician. That would be a very difficult role. I mean, basically half the country hates you all the time, right?
All the time.
And even in your own party, right? You're fighting about everything. But that, I think, is one of the greatest challenges that today's politicians need to think about, is how do you make sure that as many people as possible are participating in this in a way that is actually constructive and good, and not just purely focused on social redistribution of wealth, because that can go too far. What you need to have is value add participation in the wealth that's being generated, or in the nominal inflation of liquidity. Because if all the liquidity is going to banks and none of it is going to individuals, you're going to get this K-shaped economy thing, and it's going to lead to problems.
The conversation took a really sad turn from something so positive, your amazing education. You're a very, very smart character. Mate, let's get into something positive now.
Yeah,
let's get into Barton Gold.
Yeah, so like Barton Gold is, well, for better or for worse, it is a company that was born of a long-term macroeconomic, basically, investment strategy built around some of these things that we're talking about. So in 2015 and 16, I had decided that I sort of had enough doing advisory work. We were doing a lot of distressed recapitalization, equity, and credit. I'd spent the last sort of 5 or 6 years working in both investment and advisory in resources and resource-adjacent companies. So service providers, financiers, all this. And I'd built this, what was a really interesting kind of almost bird's eye view of all the concentric circles of activity and the service providers and trading and everything that happened around resources in Australia. And with 2016 coming around, at this time, we just had this moment where I kind of looked at the world again and I said, things are getting a little bit weird again. I went back and sort of thought about, what was my thesis when I thought things were going to get really shaky pre-GFC, and what did we see happening? You had really poor corporate, consumer, and sovereign credit. You had excess liquidity. You had, a huge inflation wave coming. And I believed at that time that we were looking at that same setup. I mean, corporate consumer and sovereign credit was way worse than it was in 2008. Tons of money had been printed, right? So in 2009, if you remember when the U.S. government bailed out the banks, the TARP program, and it was $700 billion, and everybody was outraged. If you say $700 billion today, nobody blinks because we're talking about trillions. And that's because following 2009, they just kept printing that money every year. Essentially, they just left the printing press on, closed the door, turned off the lights, and this just drove this huge capital markets boom that we saw since the bottom, I think it was March 2009, the absolute bottom of the GFC. Now, Australia was very, very fortunate that China suddenly went through a boom, and we were literally exporting raw commodities to them. So Australia did very, very well through this period of time. But in 2016, we're back in this situation. It looks like we're going to have a big inflationary kick at some point. And then we had two really pivotal political events. Right? We had the Brexit vote, and we had the U.S. presidential election. And this is the one where, Donald Trump became president for the first time. And, these are two like seismic political events, and not least because, there was so much sort of drama around them, and everybody has, I think, a strong opinion one way or the other. And then not a lot of people don't have an opinion about Brexit or that election. But my view on that was, particularly at the time, was looking at the environment around us and saying, and I think one of my favorite things is to say, look, read the event and not all the words, right? Because all of the media and everything is people just filling, making the cutoff at 4 p.m. Everyone's got to publish something every day. And so you will often see one headline says, markets are up today because of X, and the next day markets are down today because of the same X. So a lot of the noise is just noise. But those two elections represented something fundamental, and that was the two leading proponents of the Western liberal order, the sort of post-World War II NATO-led globalist approach to the economy, the world, everything, saying we've had enough. We're gonna look inward now. Essentially, they were sort of more nationalistic platforms, and that was a real moment. And my view on that was, when Brexit passed, when the sort of deglobalization, fragmentation, more nationalistic platform of the Trump administration won in 2016, saying actually the populations of these two countries really support this message. That being the case, what happens when the leader of an ever-expanding balloon pulls back? Well, that balloon contracts. And nature abhors a vacuum, and enemies love a vacuum, right? So geopolitics is all global competition. And my theory was that, one, we've already got this huge inflationary setup coming. But two, we're going to start to see essentially continental drift between traditional trade, geopolitical, and military allies. We're going to see fracturing. We're going to see distance growing. And into that void are going to come the people who are maybe the opponents of the traditional post-World War II NATO-led order. And they're going to take advantage of these moments. And we're going to see increased conflict. We're going to see trade conflict. We're going to see monetary conflict. Yeah. The ultimate outcome of that, in my mind, was that gold actually was going to become something that was not only maybe an inflation hedge, but something that would actually become a little bit more central in sort of the body politic globally, right? It was going to have to become more central again because people were going to move away from being so excessively aligned to the United States and U.S. dollars, especially if the U.S. is like pushing traditional allies away. The U.S. is over-levered. And one of the things that we had picked up on at the time was, China and Russia started buying gold en masse. I mean, just buying it hand over fist in 2014, and on net they stopped buying U.S. Treasuries. So I had an early suspicion that this was going to become kind of a runaway train, and this is now what all of these other countries have piled onto.
Did you expect it was going to be $7,000 an ounce? Did you think it was going to go this high?
I did. I just didn't know when.
Where do you think it'll get to?
So
that's a tough one.
That's a tough question. Look,
10.
I mean, look, the question is when. It's always when, right?
Definitely.
So yes, months. I think the Australian dollar gold price will get to $10,000. I'm not sure when. What I would say is my view is that people would move away from the US. They would move away from dollars. If you de-dollarize any market, you need to have a new reserve store, right? So the demand for US treasuries, the demand for US equities is driven by all these countries who have these massive trade surpluses going, hey, now I have 800, China's case this year, 1.2, $1.3 trillion in surplus. What do I do with these dollars? I'll go buy S&P 500 securities. I'll buy US treasuries. Well, now they're saying, well, I don't want to buy so many of those things. I'm going to buy gold. And that is what's driving this. And now all these other smaller countries are realizing they also need to have gold because they want to be able to settle trade outside of US dollars.
Yep.
And they're a little bit nervous about standing so close to somebody who maybe they don't like the rules they've had to behave, had the rules they've had to obey for banking regulations. It's all of these, the US's, banking regulations are essentially a huge tax on smaller countries. It's very, very costly to bank with the US. So long story short, if you're going to de-dollarize economies, gold had to be monetizing, right? So it's the only geopolitically neutral reserve asset. And when we talk about when did we think it would get to 7,000 or 5,000 US dollar terms, I was always fairly certain it was going to get there. But one of the really fateful things that the US did that really catalyzed it was the decision in 2022, 2023 to attack Russia's US Treasury holdings as opposed to just sanctioning Russia. And this has become this has been a key event point that people have now, I think, commonly agreed that this was sort of the 10,000 ton load of bricks that broke the camel's back for the US dollar and the desirability of holding US Treasuries. That was the first time the US really showed everybody, look, if we don't like your policy, we're not just going to sanction your economy, we're going to push pause on your US Treasuries, right? Those reserves, that safe store of value that you rely on to keep your, to buy energy, to keep your economy on so that your citizens don't revolt against you, you've just lost access to that money. And that means the US Treasuries and US dollars and any asset they hold inside the US, which includes 70% of the world's managed wealth in US markets, that's no longer safe. So all of these people start to say, I now need to buy gold. And that was the breaking point where we saw all of the traditional relationships that we all believed existed between gold and foreign exchange rates, gold and interest rates. All of those just broke. And everybody started piling into gold. And we've seen this incredible, accretion in value. Now, where does it go? We are 2 years in to unwinding a 50-year aberration in global monetary agreement, right? The United States rather cleverly convinced the world that holding US dollars was as good as holding gold. And they did that by getting Saudi Arabia to agree to price energy in US dollars because the energy market is by far the largest market in the world, right? Now, however, so as goes the energy market, will go every other market. And therefore, that's why we see all other commodities priced in US dollars. So for 50 years, the demand was for the US dollar. And this is why the US dollar is artificially strong and nobody cared about gold. That's now starting to reverse. And let's not forget how much printed money is out there today versus how much printed money was out there relative to gold in 1971, 1973, whatever you think was the real starting point for this. My point is gold has to find a new equilibrium in terms of the proportion of global trade that is settled in gold because sovereigns now want physical gold. They don't care about paper gold. They're not buying ETFs. They want gold in reserves in their own vaults for safekeeping and a rainy day and to use as trade settlement. We trade, natural gas. We trade coal, iron ore. And at the end of the day, there's a balancing account. And they say, well, I'll take some dinars, I'll take a few US dollars, but the rest I want in gold. So gold's going to find an equilibrium there. And gold's also got to rediscover an equilibrium of what is the correct ratio of all this printed money versus the limited number of ounces of gold that are out there. And these two equilibria are going to, basically merge somewhere. And my theory is that the number represented by the proper equilibrium point for gold in trade and monetary policy is considerably north of where it is here.
Yeah.
I couldn't pick an answer, but all the most credible long-term models I've seen would put gold between $20,000 and $30,000.
Shoot, there'd be some. So buy gold shares wherever.
Look, yes,
We can't
right?
say that. Well, I mean, I can say that.
Yeah.
Depends where you're keen to put your money.
And look, I think that the thing is right is commodities generally have been underpriced because again, what we did is we commodified the U.S. dollar. The dollar was what we demanded, and we used to believe until recently that if you had a U.S. dollar, you can get anything you need. And we're learning very quickly that's no longer true, right? China has locked down rare earths. You can throw dollars at them, and they can say, "Nope, what are you going to use them for?" "Oh, we're gonna use them to make weapons to point at you." And they say, "Oh no, can't have them," right? So dollars don't buy anything anymore. And now you now are seeing even Western economies adopting industrial monetary policy, printing currency to buy commodities themselves. The U.S. is going into rare earths projects and tungsten projects, used for hardening artillery shells.
Yep.
So I think we're with the de-dollarisation of commodities. I think we're on the front end of something that is essentially a structural shift, and structural shifts are much more than your typical cyclical market rotations. I think we could be on the front end of something pretty amazing, and gold will be the thing that absorbs the most of that inflationary value. And look at what has happened in the last 6 months, right? Newmont is a great example, like tabletop example of this. Newmont was in, let's see, September, October, they're like, $130 a share, right? The gold price had been cruising around 3,200, 3,300 US. And this is where we had that first moment where the gold price just went up like crazy. And then it crashed and everybody panicked. But it was like an aircraft that went nose up, right? Stalled out and then crashed to a new high. So it went from like 3,200 to 4,400 to 4,000, right?
A crash isn't probably the best word.
Well, that's the thing. But people panicked, right? And so what you saw was even Newmont, right? The gold price has gone from 3,200 to 4,400 to 4,000, crashed to a new high, and Newmont shares went down 20%. And then the same thing happened over the last 3 months. You're coming through January, and the gold price is going up and up and up, and all of a sudden the plane is nose up again, and it stalls out and it falls out of the sky. Everybody starts panicking. And then the pilot recovers, and now we're at 5,000. So between September of last year, or October after the first crash, to now, the second crash to a new high, the US dollar gold price is $1,000 US higher. Now, Newmont, during this most recent crash, lost about 25 billion US dollars in market cap.
Wow.
But as a 6 million ounce per annum producer, they are making, from 3 months earlier to now, an additional $6 billion a year in operating free cash just because the gold price went up. Do you know what their operating free cash was for all of 2025?
What was it?
It's like $7 billion. So they've nearly doubled their operating free cash, and you can buy them basically for the same price that they were trading at when the gold price was $1,000 lower. So people are so uncertain about the volatility that it stops them from looking at like the deep, deep value here. And if you do believe in a long-term gold trend, if you believe in a long-term commodities trend, well, if commodities prices are going up, it's going to drive inflation, and inflation is going to drive gold. So gold's going to benefit. And I think getting into quality gold names now, people think, did I miss the boat because these companies have gone up 200%? Well, they've gone up 200% from being down 90% because it's just been such a difficult market for gold equities. Again, we're just at the beginning of what I think is the reversal of 50 years of monetary aberration, right?
Wow.
Yeah.
So everyone should be putting money into Barton Gold?
Well,
Barton Gold, what's the shares today? What's the share? Is it $1?
I'll put it this way. We put a lot of money into Barton Gold. So, we back ourselves, and we think we've got a pretty interesting story. And I know I've just been rabbiting on about all this other stuff.
But it's very interesting.
I think we are trading about $1.10 per share today, which makes us about a $270 million Australian dollar company. We had about $17 million at the end of December, so called it $250 million enterprise value. And look, I should probably explain, who we are and what we're doing, but it goes to all these things, right? So background being, here's this idea about gold. We want to build significant gold exposure in a tier one jurisdiction where we don't think, the rules are going to change. We don't think the lines of geopolitical control are going to change. We're in Australia. We have got tier one geology, tier one rule of law, tier one operators, right? Great employees, best safety record in the world. Well, we should probably be looking at building a gold platform here. And, we did in the first place what most people think to do when you think about gold in Australia is you look at Western Australia, right? You
didn't?
Well, we did. We looked
Oh,
at
you did?
we looked at a lot of assets here. Yeah. So we actually, I won't name them, but there's a couple assets that have become very successful that we were the underbidder on, that we looked at buying, and that some really, really good operators here have really done some amazing stuff with. So I definitely take my hat off to them because these guys were going and looking at assets that were maybe a little bit left of center, a little bit unloved. And these are the things that we loved because we knew we could get in there and do it differently and see it differently and create value. So these guys spotted it, they did it, they unlocked the value, and they have just crushed it. Great. Well, eastern margin of Queensland is another place you look typically for gold. One place you wouldn't traditionally look for gold in a contemporary setting is South Australia. And the reason is that we're in the center of South Australia. So this is the Gawler Craton. It's a globally renowned geological domain.
I'd never heard of it until I looked it up. Actually mispronounced it to you.
That's all right. But so this is where Olympic Dam is, right? And people might not be familiar with the name Gawler Craton, but most people are familiar with Olympic Dam because they're familiar with BHP Billiton. Olympic Dam sits in an iron oxide copper gold belt, or IOCG belt, that also hosts two projects operations called Carrapateena and Prominent Hill. And those were owned by Oz Minerals. BHP bought Oz Minerals. So BHP has essentially consolidated the copper belt in this district in the middle of South Australia.
Amazing. Certainly now.
Yeah, oh, absolutely, right? So there are a number of reasons they did that, right? So they were looking at mitigating risk in Olympic Dam and getting benefits between these operations, but they obviously have huge exposure to this copper story, right? Everything we're talking about, electrification, AI, everything is basically driven by copper. But the really interesting thing about this is that just to the west of that copper belt, there is a 130-year-old high-grade producing gold district that everybody just forgot about because in the 1980s, 1990s, pretty much all of the money going into mining exploration in South Australia started getting diverted towards copper and the excitement about what was going on in this copper belt. And this is particularly true when the gold price kind of crashed at the end of the 1990s. So when gold exploration became fashionable again in 2006, 7, and 8, right, the gold price had gone from like $250 up to like $600, $700, $800 US. You naturally people go where, muscle memory takes them. And so they went rushing back to Western Australia and they went rushing back to the eastern margins of Queensland. And because there had been such insufficient contemporary investment, and we're only talking about, the prior 20 years, people pretty much didn't go rushing back into South Australia. And for us, we thought that was a classic asset mispricing opportunity. And that was really quite exciting, right? Overlooked assets, overlooked value. So we spent about 3 years between 2017 and 2020 quietly assembling pretty much every significant historical exploration and production asset in the region. We also got control of the only mill, and then we kind of popped up in 2020.
That was one of your early purchases, wasn't it? A processing plant.
It was, yeah. So before we kind of broke cover on everything, we made sure we had control of that plant because it's the only mill in the region.
Amazing.
And, whatever your plans are going to be, that's a really good thing to have in your back pocket, right?
It's what everyone needs right now.
Yeah.
It's what everyone's screaming for right now.
Yeah. So, old plants require work to get going, right? You can't just shut down a plant and come back and push the green button one day and it's going to wind up again. You got to at least pull it apart, get everything cleaned up and put it back together. And we published a study indicating that it'd be about 30 million Australian dollars just to reinstate that plant as it was running before.
What year did you do that?
Sorry?
What year did you do that?
We published that study last year. So I think it was July of last year, 2025. And that was focused just on reinstating it as it was before. So 600,000 ton per annum hard rock capacity. What we are looking at doing is saying, how do we use that infrastructure and modify it or enhance it to also look at potentially processing some historical higher grade tailings that we have? So our methodology with that plant was get control of it and then stop talking about it. So we literally didn't talk about this for 3 years, and we focused on our Tunkillia project. We built that from 0.6 million ounces to 1.6 million ounces and demonstrated that that will be a 120,000 ounce per annum producer. And now we've come back to this mill and we're working on this again. And the idea was, the way I think I'd like to describe it is sort of doing second things first. And you had another great guest on, Alex Rivera, right, talking about this and
It's amazing.
talking about getting something going, but needing to know where your growth is, right? So the market always wants to know what's next. And if you just start a small operation, there's nothing wrong with producing 20 or 30 or 50,000 ounces, and it's all hard and it's a very admirable outcome. But if you want to move beyond that, once you've started a small operation, it's very hard to lift your eyes up to the horizon and try to figure out where your growth is going to come from, because you're very, very focused on what's happening right in front of you. We decided to establish the growth pathway first and then go back, leverage that infrastructure, get into operations, re-rate the company's equity and credit profile, and then use that as a springboard to then go and build our second project. So when you look at the mill itself, $30 million to reinstate that mill. Maybe we add some more for some fine grinding technology. We clean up the camp. The idea though is, I don't think we're going to spend anywhere close to this much, but you could spend $100 million on a fully approved existing facility today and be 2 to 3 years and $200 to $300 million ahead of anyone else who wants to start operations today. I mean, it takes a lot, including studies, engineering, permitting, approvals, and then construction costs to build a mill.
Yep.
So it's a huge leverage point to have in your back pocket. So now we're going back to unlock that. We just did 2 resource upgrades in September, I think June and September last year. We're doing upgrade drilling right now to convert those into reserves. And what we're trying to do is a really simple restart model. So I love the term, which I think I've probably heard this used in Australia more than anywhere else, but shooting the lights out, right? And I like to turn that on and basically say, we're not trying to shoot the lights out. We're just trying to turn the lights on, right? You don't want to fall on your face in the dark. So what we're trying to do is say, look, let's use historical higher grade tailings. They're like coarse free gold tailings, those, and some simple.
You've sent those off to the lab?
Oh yeah. So we've done metallurgical test work on all that, comminution test work.
What's the tailings coming back at?
Well, so the older, there's 2 tailings facilities at Challenger there. And the second one is still open. So you can produce and put stuff into that right now if you want. The older of the 2 was servicing the Challenger mine when it was a 5-gram open pit and an 8 to 10 gram underground. So, but again,
Wow.
at an historical low gold price, the incentive is not to sort of get every percentage of that gold out. It's to move through the mill as fast as possible. So what was happening was they were actually under grinding the material. The original target grind size for that plant was between 75 and 120 microns. So basically a very fine powder to then put it in a leaching circuit to get the gold out. And that's a fairly typical target grind range. When we drilled the tailings facility and then did some material sizing, 2 things jumped out. There's essentially a higher grade outer ring around the facility because there's a bunch of spigots where the material gets deposited, right? It's just sort of liquid going out. And 2, the material is very coarse. So instead of having a P80 or 80% of the material passing 75 or 120 micron, it was 225 micron. So it's very fine material, but it's coarse relative to its actual target grind size. And it has very simple, clean gold metallurgy. There's no copper, there's no zinc, there's nothing in there that's going to cause problems in processing. So in that case, you target that higher grade ring where you have material between 0.6 and 1 gram gold that's already been dug up, it's already been crushed. Most of the energy's gone into grinding it, and you just regrind it a little bit and throw it back through your circuit and get the rest of that gold out. So the test work indicates that we can recover 60 to 80% of that gold just by putting it back through the circuit. So it's an interesting way of thinking about making this asset
So
kind of
that
pay
you're
for
just
itself.
using the existing technology. There's no introduction of new technology for reprocessing tailings.
So there's no new technology. We are looking at adding a fine grinding unit, so tertiary grinding or fine grinding, and the idea is to be able to take it from 225 micron down to 30 to 40 micron to liberate that gold.
Okay.
But there's nothing complex about it. The gold is not refractory. Once you grind it, you put it in the circuit, and it recovers quite simply. So it's sort of a continuation of our methodology of making these assets pay for themselves. So we did a placement in October, cornerstone by Franklin Templeton, which is one of the world's biggest precious metals funds. So it was like a really big moment for us, representing the sort of next step for us, right? Moving from our first 5-year act of build the concept to the next 5-year act of execute, the strategy. Before that, we had only raised $13 million publicly. We actually earned more money in profits internally, producing and selling gold concentrates, selling old camp, renting our camp to other people, working with the state and federal governments with grant and rebate programs. So we've got this sort of reputation for being very scrappy and making these assets pay for themselves, which I love because I come from a sort of distressed credit background, and I walk out to what looks like a junkyard, and I just see piles of money everywhere, and I'm trying to figure out how much does it cost me to lift up that money and extract it. So we can literally go into the old trash, the old output of the plant, and get that higher grade material, and then use that to get it going, and then bring in lower risk open pit material, still not targeting the high grade underground.
Are the pits close to the plant?
Yeah, so I think everything's about a kilometer away from the plant.
Oh, awesome. Haulage is going to be
correct.
Fantastic.
Yeah, so you have the original open pit, which I think went down to about 140 meters depth, and then it went underground in December 2024. So it was basically a year and a half or two open pit and then an underground. So what we're looking at then is tailings, and then actually lower grade but much, much lower risk, easy to access open pit material. So the strategy is as much about deferring risk and complexity of going into the underground, bring forward simple material, make a simple step, turn the lights on. And the minute you've turned those lights on, right, and this kind of goes to some of the points you were talking about with Alex, once you have that mill turning and it's just washing its own face, you have just increased the development optionality of every other ounce you have around it, whether it's the high-grade underground mine, all of our surrounding kind of regional enhancement assets. We've got Tunkillia, we've got the Tolmer asset, the silver discovery, we've got the Wudinna project we just bought. Once you get that going, it is so much easier to then add that next layer of risk and complexity to say, okay, now let's go after the underground. And by the way, now we know how we can squeeze the most out of it. We've given ourselves time to think about it. The mill's running. So the probability of success is extremely high in that ounce, and the profitability is going to be extremely high.
That'd be fantastic, getting that money in the bank for plant upgrades.
Yeah, absolutely, right. And the other thing that's really interesting, and because people ask what happens when you go into operations, right? And everyone's asking the story about your share price. What's going to happen to the share price? And obviously, very interesting things happen when you move from pre-producer to producer, right? You draw attention because you've changed your profile, right? And I think a lot of people have the idea, and it's true on a long enough time horizon, that you go from being pre-producer where you are a capital consumer, right? Like we are relying on our shareholders to support us, to invest their hard-earned money in us to deliver return to them. And then you go to being a producer, and you can, in theory, return that, whether through higher equity value or dividends and whatnot. But what happens first, I think, is actually critically more important and more subtle, is that people begin to accept and realize that you don't need to keep coming back to the market for a capital raise every 6 or 12 months, because you're no longer a net capital consumer. And that first share price rise is almost a relief rally. It's almost like they've made it, right? Like they don't need more money, and therefore a capital placement is not coming every 6 months, and people can start to then price what you actually have and the growth pathway they see. And that's why it's so critical that we have then laid out the Tunkillia project, which will be one of the fastest returning projects in Australia. It has literally a probably 3-month payback at the current gold price. It's ridiculous. So
Who named it?
Tunkillia.
Where did it get its name?
I don't know who named it actually. It was it was discovered by Helix Resources in 1996, and there was a moment when people got really excited about South Australia, and it was about 5 minutes long, because the Challenger mine and Tunkillia were discovered within 6 months of each other, everybody went rushing into South Australia, and then the gold price crashed, and everybody stopped investing in gold generally. But so we've got some great names out there. The Tunkillia Goldfield, all of the old discoveries and hits are named after Melbourne Cup winners. So there's all these naming traditions. But Tunkillia is a very different asset, large scale, continuous, shear hosted, bulk open pit mineralization. The thing that we always liked about that asset is, one, we knew it had scale to grow. It was 0.6 million ounces. I was fairly sure it would grow. I'm not a geologist, but I was looking at the data saying, this data doesn't close off. Thinking about sort of the cloud of data, if you will. I guess I'm a mathematics stats guy, I guess. So I was actually fascinated to learn how similar geological modeling mathematics are to some of the really arcane, boring stuff I was doing in school. But what we could see in the data, the most important thing we could see in the data was we thought there was a higher grade zone hiding in the middle. And that's proven to be true. So you got this very broad bulk open pit. It's like 80 or 100 meters wide of mineralization. So imagine a football field long wide, and it's all ore. And in the middle of the deposit, there's about 300 meter long zone where 10 to 20 or 30 meters of that grades between 2 and 10 gram per ton. And what it means is, in your initial starter pit, as we call it, the average grade is 50% higher. So your first year, you're not producing 120,000 ounces, you're producing 180,000 ounces for the same, more or less, fixed cost of running a 5 million ton per annum plant. And that means that compared to the life of mine average cost of about 2,200 Australian dollars per ounce, and the typical AISC calculation, your cost of producing an ounce of gold we calculated it as 997 Australian dollars. So $700 US today. Oh. So for at least its first year, Tunkillia would be one of the lowest cost gold producers in the world. At a $5,000 gold price, it was modeled to produce about $800 million in the first year, or pay back the whole development in 1 year. The first 2 pit stages are modeled to produce $1.3 billion in the first 2.5 years, paying back development 3 times. That's at 5,000 Australian gold and $50 silver. At the current gold and silver prices, it produces about $2 billion in 2.5 years and pays back development 5 times over. So you could just literally say,
Barton Gold, instant mid-tier.
Well, you're definitely jumping up. You're going up into that 150,000 ounce per annum production range. There's a silver credit there that has become much more attractive in with the current evolution of the silver market. But the idea is that financial profile, right? You're producing lots of money, but it's coming back so quickly. What it means is, one, on a standalone basis, this is a very attractive development asset in terms of its absolute returns, in terms of its relative returns, the speed of its returns. It's a much lower risk financing prospect for tier 1 institutions, right? So, the big banks have this interesting dilemma. They want to lend a lot of money, and they want it out for a long time so that they can get a lot of interest. And it takes as much effort for them to lend $20 million as it does 500 and vice versa. So they want to get as much money out as possible, and they want to know they're going to make enough of a profit to justify the effort. But they also want to know that if push came to shove, you could pay them back as soon as possible. So when we modeled this, it's certainly got a lot of attention, because the banks can be very, very confident that even if the gold price got cut in half and we only operated this pit for 2.5 years, we could still pay this thing back 2-3 times over. So it's, in isolation, it's very attractive. It's even more attractive if you have an existing mill here that allows it to springboard over here, right? And then this is more attractive because these credit providers and financiers know, hey, these guys are not, dreamy-eyed developers. Right next door, they've got another plant going. These guys are actually producers. They have cash flow. They have a better institutional credit profile as a company, and it just opens up so many doors. So we're pretty excited.
What would be the biggest risk that you're mitigating at the moment? Because all of that is extremely positive. That's just all great news.
So the risk, what I would say, the risk that I think about a lot, and this probably reflects the fact that like you could ask me this question and I could just like blank out, go glassy-eyed, and go into my head for hours thinking about this, because I think about things in sort of timing of cash flows and everything, but breaking down risk and quarantining risk, and that you can sort of see that in the way that we talked about bringing forward lower grade but much lower risk material with the startup of the mill. The biggest risk in these things is knowing your geology really, really well, but within the geology, understanding your metallurgy really, really well. And, we are very blessed that we do not have refractory material. And in all of our assets, even in the big shear hosted deposit, we have, for example, like not even trace copper. So we don't have copper in there that can essentially steal cyanide from the gold. But even if you think about, okay, you've got, simple geometry to your resource, you've got clean metallurgy, you have to think about everything in 3 dimensions, because the success of mines and mining companies it's not linear. When you build a financial model, the more data you have, the greater density of data you have, and the tighter frequency. If you could model your operations on a daily basis, you can much more precisely model what you're going to be producing. But you really need to understand the nuances between how the metallurgy may literally change from this domain to that domain as you move through the deposit, because mining models are about timing of cash flow. A quarterly or annual or even like monthly model can show you essentially average inputs and average outputs, but inside that time you can have cash flows swinging like this, and you need to know how that's going to vary as you go through the model, and that'll be driven by what are your consumables, your energy costs. So how hard is that particular block of ore that you're going to mine today versus the one you're going to mine in 3 weeks' time? How much cyanide and lime do you need to actually process that material versus the type, the amount you need for that material in 3 months' time? I spend a lot of time thinking about how we can get our feasibility study models as close to a production model as possible, so that we can model right down to our consumables as accurately as possible, so that our financial partners can take confidence knowing like we've really, really, really thought about this, and they can look at the data and say, we see a huge amount of buffer in this for safety for them to get repaid. And what really keeps me up is we want to do this as fast as possible, of course, but we want to make sure we do the right work the right way and execute at the right time. And so we feel a lot of pressure from ourselves to go forward as fast as possible. And one of the biggest challenges is actually almost restraining yourself and saying, you got to walk before you can run. But there's also intermediate steps, right? You need to crawl before you can walk. You need to jog before you run, and then you run. And actually just restraining yourself, make sure you're making the right decisions. And a lot of times it means blocking out the noise and saying, it's my job. I mean, fundamentally, at the end of the day, like we're the largest investors in the company, and we really sort of think of ourselves more as, professional asset managers. All of our investors are investing their hard-earned money in us. Like we are custodians of our shareholders' capital. So,
it's a great way to look at it.
Yeah, and we have more information than anybody else. And we're juggling thousands of pieces of data, all sorts of different pressures from the market, including, the gold market itself, the funding market, the share market. We've got to make the best decision that we think is going to present the best risk-adjusted return for our shareholders over the long run, not what's going to be exciting or fun or seem like a good idea in the short run. And then you run to turn on the lights in the dark and you fall on your face, right? And that's really the risk. So I spend a lot of time thinking about how we mitigate the risk of each next step. And one step, if you can break it down into 3 smaller steps and identify the key risk points, that is how you're going to get to the end of the journey with far fewer cuts, far fewer scars, and, all of your limbs and all of your fingers. And we have fundamentally, we have a very tight capital structure. We've got 240 million shares outstanding. If we can do this well, if we can, make the decision to use the right amount of dilution to make sure we're properly capitalized and we are moving at the right pace and we take the right steps and we execute those well, our shareholders are going to be way better off in the long term, because the real prize is then getting to Tunkillia behind it and then getting into our regional enhancement assets and consolidating this region with low shares on issue and a pathway laid out like that. It's now all about risk-adjusted execution. And we can deliver far more value than rushing and effectively doing something wrong and having to recapitalize and having more dilution in the long run.
What do you think investors are misunderstanding about Barton Gold?
Look, I think people really actually are starting to get a pretty good idea of kind of who we are and how we think about things. As I mentioned, we're probably better understood as like professional asset managers and developers, right? So we're running, what is to all outward appearances a junior mining development business, but we're very intent on producing gold because this is actually a global macro thesis playing out just in the physical expression of gold assets. So we're quite focused on that outcome because we believe in the monetary value of what we're doing, in a geopolitical sense. And a lot of people have made the comment that we're no longer playing mining, we're playing geopolitics. Like geopolitics are diving right down into these assets, and geopolitical players are diving right down into assets now. It's pretty interesting. When you think about what do people need to understand, I think the people who've been following us now understand how we think about things like asset managers. And that means also how we look at what we have as a portfolio. And we think about how we leverage one asset to benefit another and vice versa, right? So creating optionality between assets creates more value between all of them. And if I wanted to look at these assets fresh, if I was coming at Barton Gold fresh today, I'd be asking myself, what is the value of these assets individually if I wanted to separate these things and either use one asset to pay for another or run them and finance them separately? We're in some respects competing with people for awareness, right? The currency of awareness is one of the most important currencies for a public listed company. We've spent the last 5 years building a platform that can deliver near-term production, medium-term scale, and long-term regional consolidation.
Do you think some investors would be maybe not scared off, it's not the right word, but do you think they'd be more interested in investing in Western Australia, where predominantly gold, or South Australia? Do you think could be a turn-off for some investors?
Yeah, look, I'm not sure it's a turn-off, but like you sort of say, predominantly gold. Is it predominantly gold, right?
I mean, we've got so many.
WA is, huge, right? But like if we turn and look to the east from your studio here, right, there are 900 gold stories that people can hear about, running the range from, total moose pasture, limited, greenfields exploration up to some of the best gold miners in the world, right? And not so very far, literally, from your studio. So there's a lot of choice. And if I have a point to make about like what do people not understand, is just that they're not really yet aware of what we're doing in Western Australia. Perhaps they're not as aware of what we're doing in South Australia because they've never had to look further afield. There's so many good options here. So we focused on essentially completing our first 5-year act where we can say, hey, now we are going into production. We have a mid-tier target. We've laid out that pathway, and now it's actually relevant to investors in Western Australia because now we have a story that is actually compelling and can stand out. So I think it's not necessarily misunderstanding. It's a lack of awareness. And what we've seen, and we measure these things in our daily liquidity. Like, again, I love looking at numbers, but what we see is when daily trading volumes in our shares are going up, there is a direct correlation with material revaluation. So every time we do something like, for example, last year we made like the highest grade silver discovery in the world last year. We put out the highest grade silver hole in the world in the middle of a gold field. It was a total surprise. We were targeting a structure. We're not targeting silver. That grabbed people's attention. And then a lot of people were saying, wait, who's Barton Gold? Oh, I wasn't aware that they had all these things. And we do have people, and we were just at the RIU conference, and we had people asking us like, I can't believe I've never heard of you, but they have 50 names in their portfolio they're watching every day. Like you can't follow everything.
For sure.
So these moments where we say, okay, here's a platform. Now we can commercialize this. Now this is relevant to you. This is going to be enough to get your attention. Oh, by the way, we've made this really high grade silver discovery. And that's like our exploration kicker next to this really boring commercialization of a company that could be producing $1 billion in revenue, right? From just these two little assets. That's where people start to become aware. And then you'll start to see sort of valuation merge with maybe our Western Australian peers. And, I can use a really great example. And as somebody maybe you've spoken with, but, Mark Duclair running Astral, right? Like, big fan of Mark. He's just, cut and dried, gets to the point, like, very kind of human, personable individual, not, like Alex, you had in, like, but all over his game, right? Knows what's going on, knows how to communicate to people. They have their Mandela project, right? Which we, again, I've looked at that project extensively in the past. There are very few assets in Australia that are actually peer or comparables for our Tunkillia project, right? So large scale, bulk, continuous, single open pit, low to moderate grade. And the Mandela project is probably the most comparable project that I see for us in the market. Astral today have a market capitalization, I don't know, somewhere like $450 million or $500 million. We have a Tunkillia, and we have a mill, and we have a high-grade underground mine, and a really high-grade silver discovery. We've got all of these things, and we're valued at $250 million. So I think the point is awareness is the point where you start to see value realization. And, we think we present pretty deep value, and we are, all in on unlocking that value. And that's something we want more people to understand, that, because we want more people to see us not as a sort of traditional, swashbuckling, gunslinging, stereotypical image of a junior, but people are really serious about bringing the next generation of investment methodology and discipline and risk mitigation and capital discipline into developing what is effectively, in the precious metal space, literally producing money. Gold is becoming money again. And I think there's going to be a re-education of the market to understand just how important gold production is, both for, governments, but also just, for individuals.
I think that's amazing. Mate, this is the last question. What's the best advice that you've ever received? I did tell you this. I did tell you this one right at the start. This will be our closer.
Look, this was advice I got pretty early in my life. Probably the first real mentor I had was during my undergraduate university years. I was in all the honors programs at the school, and we were in a small Jesuit university in California. And so we had these really great mentors from like the local business community who would, come in and literally buddy up one-on-one with the students in our program. And I had this mentor named Patrick Yam, and he's been through everything and seen it all through like the really exciting booms and busts of the various different market cycles of U.S. capital markets. And so this is somebody who's got a lot of life experience, right? And like, there's knowledge and there's wisdom, and wisdom is the product of knowledge times pain, right? Like it's, there's a big difference between like book knowledge and wisdom. And one of the things he said to me, and it was like one of the first things he said to me, and it's one of the things he reminded me about like ever since, anytime we spoke.
You still keep in contact with him?
I do. So I rarely am back, in the US for an extended period of time, but I try to catch up with him, every probably 5 years or so when I'm back in California, and I keep in touch with his son by email. His son's gone on to be like a biotech. Well, I don't know how we call it, but like a health tech CEO of a company that Patrick has helped guide to this really interesting technology.
Amazing.
But he said to me, like, don't forget the ROTI coefficient. And, you learn all these things when you do your education, and all these like, acronyms and, all the, the ratios and stuff that you're supposed to know as like rules of thumb. And I was like, what's ROTI? And, because you have like return on capital investment, return on equity. And he goes, ROTI coefficient, return on time invested, right? And it was one of those things you can't understand that when you're younger and you're 10 feet tall and you're bulletproof and, you can run through walls and you've got all the time in the world. But as you go on in life and you realize you have to spin wheels, and you have to fail, and you have to face difficulties, and, kind of get your scars before you really learn these valuable lessons. Because again, it's the difference between something you read or something somebody told you and
That's
experience.
Awesome.
But return on time invested, right? You have to choose very carefully the people that you choose. You have to choose very carefully the people with whom you associate, and you have to choose very carefully to what you commit your time, because the wrong people will consume your time and waste it, and the wrong opportunities
Will be missed.
Well, the good opportunities will be missed if you're spending all of your time on something else. And you have to make sure you're not pouring too much of your time into something that is not delivering a return, whether it's, not even just financial, but, what's good for you personally, right? You can burn yourself to the ground chasing things that you think are, financially meritorious. And I have made this mistake. And I've made this mistake to then realize like, oh God, I should have listened to this. Like, but you don't realize it until you're sort of in it. Return on time invested is a really important thing. And that is as important. The ROTI coefficient.
Beautiful.
It's as important to choosing what you're going to go into, and also important to knowing when it's time to step out of something. No one person is the right person for a given role or mission for all of time, right?
For sure.
There is somebody who can do it better than you, and I'm acutely aware of this, right? My job is to get us to the point where I've leveraged my skill sets to get us to a point to bring in somebody who's better than me, who can do this job better than me, and let me go back to doing what I do best to empower them to do what they do best, right? And I do joke with our investors, like, the faster you see me fire myself, the faster we're going to be successful, right? And that is, self-awareness, return on time invested. It's one of the best things I've ever been told, and it would have been one of the best things to have paid attention to sooner.
Yeah, that's awesome. Yeah. Alex, look, mate, thank you very much. This is certainly a longer episode for us, but the information that you've been able to pass on to me, not just about Barton Gold, which I'm going to have to buy some shares in. I would advise don't take my advice, obviously. Do your own research, but look, your education, your life in the times, the history that you've been able to pass on to me. Thank you very much.
Oh, thank you for having me. It's been a lot of fun.
Awesome. Thanks very much for tuning into another episode on the Gold Room podcast. It was awesome to have Alex in the studio. Don't forget to check out Barton Gold, the ASX ticker BGD.